Magic at Mortgage Magic. You know, the Feds raised the rates yesterday. They raised it by a quarter. And what does that mean to you? Not anything if you don't have any bills. But if you have credit cards, you have an equity line, and they raised it a quarter, that means for every $50,000 that you owe on those equity lines and credit cards, your payment will go up $10. So if you owe $200,000 on those, your payment's going to go up $40. That's not the issue. The issue is that this is going to happen 2 or 3 more times over the next year. Now, I had lunch with a banker yesterday. It was really kind of fun to have lunch with a banker. And we'd been bankers back in the 60s, and we talked about interest rates on discount rate and add-on rate and rule of 78s and all kinds of things. And we talked about blended rate. And that's what I'm going to talk about today because, you know, if you have a, oh, that's my note. It could affect you. Like if you, you know, it affects you if you got money, right? So you take your money and it can just go away. So, you know, you do have to be careful. But we talked about blended rate, and I thought I was really clever because I was going to tell you how to do blended rate today. I'm going to give you a really quick overview of blended rate, and I'll tell you why it's going to be quick because I found something. If you owe $300,000 in mortgage at 4%, that's $12,000 interest per year. You have an equity line at $30,000, at 6%, that's $1,800 a year. You have a car loan at $13,000, 6%, that's $780 a year. You add all the interest charges up, all your balances up, divide it in this into this, and you're going to come with, I didn't write it up there, it's 4.251. But here's what's important. I'm way behind the times. I realize that more and more on the computers. I know how to do the math. When I went to grad school, we studied Markowitz reinvestment theory. Formula this long. Well, now it can be done this quickly on a computer. So you can go to www.drcalculator.com/CALC blended.html, and you can put your numbers in there and it will give you a blended rate. The blended rate is your cost of all money. What I encourage you to do is to do that. Go into that calculator, see what your cost of money is, and then when you're asking yourself, should I refinance my first mortgage? Well, it can be determined by what your blended rate, what your cost of all money is. If it's much higher than the present rates, then yes, you want to do a refinance. So today I want to just start with blended rate. I'm going to do a lot of videos because things are going to be changing in the economic world. They're going to be changing in the interest rate world. They're going to be changing in the inflation world. And there are going to be some different things going on and things that a lot of the millennials and a lot of the younger people have never seen before. These are good times. I did loans, first mortgages at 14%. I did second mortgages at 18%. So those are big numbers, but they're nothing to be scared of because life goes on. So you can start by teaching yourself how much you're really paying by using a blended rate calculator. And that's all I want to encourage you to do today, to go to that calculator and blend all your balances and see what your rate is and try to always get that number down if you can. I'm Doug Jones at Mortgage Magic in San Jose.